Good day, I'm Ernie Goss, Professor of Economics here at Creighton University in beautiful downtown Omaha, Nebraska. Today we're reporting on the first business day of the month our economic survey results from our May survey of supply managers in 9 states, stretching from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south. Now what we're surveying is supply managers, so what they're seeing in the month of May, the rest of us will see later on. That's the theory in the next 3 to 6 months, so it's a leading economic indicator, and I'll talk about that. The region, as I said, is the 9 states there, and of course agriculture and energy are very important for all of those 9 states. The overall index was up to 60.5. It's the highest in more than 3 years. Of course, we're coming off some really tough weather. Now, it wasn't just tough among the 9 states. It's been tough nationally. We saw what happened in the U.S. in Q1. Now we're seeing the numbers looking better for the U.S., but our regional number was up for the month. Again, the highest in 3 years. The employment index surged, I'll use that word, surged to its highest level in more than 1 year. It's at 60.0. Now again, the index stretches from 0 to 100, 50 being growth neutral, so anything above 50 is positive and indicating growth in the weeks and months ahead, next 3 to 6 months. Now the manufacturing, although we're still seeing growth there, the manufacturing employment for the 9 states still down about 10% from pre-recession levels. Now why is that? If everything is so good, why is employment levels, why are they down from pre-recession levels? Productivity growth and the lack of any new hiring. Employers are being very cautious about new hiring, and of course they're getting more and more output from the same or fewer employees. But we'll see that even manufacturing growth, we'll see that growing and moving ahead. Perhaps we're not going to move to above pre-recession levels till 2015, but it's still up. But for the month, but down from pre-recession levels. Now we asked the supply managers about hiring for the rest of 2014. About 1 in 10 anticipate layoffs. Of course, we don't want to see layoffs, but that's very low compared to what we got this time last year. 41.3, or about 4 in 10, expect new hiring. Of those, about 10% expect significant new hiring. So 4 of 10 expect new hiring. Of those 4 in 10, 10% expect significant new hiring. Now, in terms of some of the cooling aspects, a little bit less, of our May survey of supply managers, our inflation gauge sank a bit to 73.1, but it's still up from last year. So we got a bit more inflationary pressures in our surveys this year compared to last. The index is down though for the month of May. Exports got a bit softer. The number went from 60.8 to 53.0, but still above growth neutral. Exports are very important for this part of the country. We're seeing trade exports looking better, certainly compared to this time last year. The number is moving, although it was down for the month, still above growth neutral, 53.0. Prices, we ask about the supply managers about how much they expect prices to grow over the next 6 months, about 2.4% on average. Now you multiply that by 2 to get an annual number, and it's about 4.8, a little above 4.8%. Now that's a bit on the high side. What that means for the consumer out there, the family, the businesses out there, is that the Federal Reserve is going to continue to pull back on their stimulus. Now that means by the end of the year, what's called QE3, quantitative easing 3, will be over, and the Fed will be out of the bond buying market, at least on the long end, long-term treasuries. Now what does it mean in terms of interest rates? It means interest rates are going to head higher. Now I know you're saying, hey, you economists have been saying that for a long time now, and if we keep saying it, sooner or later it will be true. Actually, there are a lot of reasons interest rates are being held down, and it's not the Federal Reserve. The Federal Reserve is moving out of their stimulus program. Interest rates will rise, but what's happening is globally everybody is so scared. They're willing to earn very low rates of interest, and they're sticking money in our treasury market, bringing yields down. Now, one of the members of the Federal Reserve Open Market Committee, now she's not a voting member now, she'll move into voting in 2015, that's Esther George, the president of the Kansas City Fed. She is among the minority, but she even raised the issue of increasing short-term interest rates beginning as early as the first month or so of 2015. So we've been saying interest rates on the short end would not rise until the middle of 2015. We could see them rise as early as the first month of 2015 if Esther George gets her way. And I have to say, I support what Esther George is saying. I support the theory behind what she's saying, and the actual what she expects to come from an increase in short-term interest rates. So that's our survey for the month of May. Here we are on the first business day of each month. We'll come out on July 1st, first business day of July, reporting for the month of June, what the supply managers in the 9 states are saying. Until then, this is Ernie Goss with Creighton University in Omaha, beautiful downtown Omaha, Nebraska. And from now till then, may your economic cup runneth over.